Stocks, one of the most popular ways to invest your money. They are so popular that many people use them as their main source of income. What are stocks and how do they work? How do you know if stocks are right for you? What rights do you have as a stock shareholder? How can you buy them? And finally, should you buy them? Let's find the answers in today's episode of Investing 101. So what are stocks? A stock, also known as equity, is a security that represents the ownership of a company. It's handled in units called shares. If you manage to buy, or in any other way acquire, a share of stock, it makes you a shareholder, or, as others might call it, an investor. There are two main types of stock you can get your hands on: common and preferred. The common stock gives you voting rights in the company. That means you can make decisions together with other shareholders about who will be in management, how the company expands, and other propositions brought to you in the shareholder meeting. On the other hand, preferred stock means that you will get your dividend payments before people who own common stock, but it does not give you any voting rights. What is this so-called dividend? We will look into dividends and different dividend policies some other time, but for now, a dividend is a portion of profit that a company may or may not decide to pay to its own shareholders. You may look at it as a way of sharing the company's profit with the investors. But don't worry, even holding common stocks will pay you dividends. You will most likely encounter common stocks since they are traded on the stock exchange. The stock exchange is the market where people come to trade their stocks. It works as an intermediary between buyers and sellers. As a buyer, you place orders to purchase stock, and the stock exchange matches your order with the seller. The same happens when you place orders to sell stock. The stock exchange matches your order with a buyer. This helps create an efficient marketplace for buyers and sellers to interact, ensuring fair and transparent trading. There are plenty of stock exchanges across the globe. The New York Stock Exchange and Nasdaq in the USA, the Shanghai Stock Exchange in China, the Euronext in Europe, and many others. Alright, so how do you buy stocks? Do you simply call the stock exchange and ask to buy a few shares of your favorite company? Unfortunately, no. To buy or sell a stock, you need someone to buy them on your behalf, a stockbroker. Now, before you picture a sleazy salesman trying to rob you of your life savings, rest assured, that's totally not what a stockbroker looks like these days. Even though you can still meet with a full-service stockbroker and get some investment tips and analysis from them, there is a much more convenient way of buying stocks: an online broker. An online broker is a stockbroker who carries out a buy and sell orders for you at a reduced commission rates compared to a full-service broker. You can simply create an account at one of the online stock brokers like Fidelity, Interactive Brokers, Robinhood, or TD Ameritrade. After that, you simply transfer the funds you want to invest into your brokerage account and buy your favorite stock. However, keep in mind that since online brokers usually do not provide any investing guidance, all the risk associated with buying stocks is on your shoulders. So, what kind of risk are we talking about? And should you invest if it's risky? Well, all investments, even the safest ones, come with some form of risk. For example, if you decide to save your money in a high-interest savings account, there is still some risk that the bank can go bankrupt. Although banks are insured, you may still not see all your money depending on how much you've deposited there. As you can tell, the risk here is quite minimal, but so will be the returns. That's because risk usually goes hand in hand with returns. High-risk investments can yield high returns, but there is a bigger chance that you will lose your money. When it comes to stocks, there are plenty of types of risk. Your companies might perform badly, the inflation may rise, the interest rates might rise as well, and so on. All of those risks affect the price of your stocks. So again, why would you invest if it's risky? Well, holding money without investing is also risky because of inflation. So taking a well-calculated risk to utilize your money and get some return is the wise thing to do. But how much risk is well calculated? Unfortunately, there is really no simple answer to that. It always depends on you and you alone. How old are you? What is your risk tolerance? Do you have some companies that you really know and believe will thrive in the future? Or do you have any upcoming payments that you need to save for? You will need to find the answers to those questions yourself. The last thing you want to do is copy someone from the internet. They will most likely have a completely different life situation than you do. So remember, always do your own research. Those were the basics of stock investing. Did you learn something new? Or have you already bought some stocks yourself? Let us know in the comments. If you liked our video, feel free to like and subscribe. Thanks for watching. And don't forget to check out other episodes of Investing 101 to make sure you don't miss anything important.